It's 3 p.m. I think we can start. Welcome everybody who joined this webinar. We are so happy today to have Dr. Angela Maddaloni with us. Angela studied at the University of Siena and then at Columbia University, where she obtained a PhD in 2002. She joined then the ECB, the European Central Bank, where she conducts research in very interesting fields, including banking, unconventional monetary policies, and also money markets. She's also head of a section in the Directorate of General Research and coordinate the ECB Research Task Force on monetary policy, macroprudential policy, and financial stability. So we are so happy that you will share your hints with us today, Angela. Maybe before starting, maybe Alex, you want to say anything?
Yeah, hello also from my side, as every day, also a couple of administrative points. So first here you see the speaker list again for the whole week. So today we have Angela Maddaloni, third speaker of the week, and tomorrow and on Friday we will have Leonardo Gambacorta and Paul Ibert. That's about the speakers list, and then as every day we will have 60 minutes of presentation from Angela and then about 15 minutes for Q&A. And Angela told me you can also ask questions for understanding during her presentation, and for both questions at the end and during the presentation, please use the Q&A function in Zoom. So either at the bottom or at the top, depending on which device you are using, you have this Q&A. Just type in your question there, and I try to have an eye on it. And if there's something urgent, I will interrupt Angela, and she can answer the question right away. And these more like general questions we're going to have towards the end. Okay, so I'm going to stop sharing my screen and then hand over to Angela.
So thank you very much. Thanks, first of all, Alex and Angelo, for inviting me to this lecture. It's very much a pleasure to participate to this initiative. So let me see now. I hope that I will be able to share the screen without any problem. Let's see. Okay, can you see the screen?
It's starting. Let's see. Yes.
Yep.
Okay. So as Alex said, I prepare some material, and I'm planning more or less to go through all these slides, but please feel free to interrupt me at any time if there is something not clear, or if you have some ideas or something. One thing that I should say also, of course, is that as Angelo has said, I work at the European Central Bank. Therefore, the usual disclaimer apply. Everything I say, and because I will talk mainly about regulation and monetary policy, actually this is quite important. Everything I say should not be interpreted as the ECB views, but only as my views as a researcher. But I will talk a lot about research, so I think this is fine. Angelo was very nice. He introduced me very nicely. So a couple of words for myself. As he said, I'm the head of the Financial Intermediation Research Section in the Directorate General Research of the ECB. So basically, I work in the research department of the European Central Bank, and I lead the section, the group of people that do mainly research on financial intermediation. There you can also find a link to my author's webpage, and you will find, if you have not seen it before, in the same area of the ECB webpage, you will find all the author's profile of most of my colleagues. Also, just for you to know, as you can probably guess from my accent, I am originally from Italy, from this very nice place that you can see here in this picture. Actually, this picture has been taken 1 year ago. And I usually spend some time in my hometown at this time of the year, because of course there is a very nice, much nicer weather than in Frankfurt. Unfortunately, this year I could not go, as you can imagine. So let's hope for the best for the following years. So now let's go on. And what I would like to say about, very broadly, what is the objective of this lecture? What I would like to bring, the message that I would like to bring from this lecture is that to show you how regulation and other policies, in particular, I will talk about monetary policy because this is, of course, the thing that I know best, influence the risk-taking behavior of financial intermediaries. And of course, I will talk mainly about banks. Also, I might say something about non-banks as well. I will talk a bit about some interaction among different policies, in particular, interaction about policies that relate to the regulatory sphere, prudential sphere, and monetary policy. And I will talk about these things basically using research that mainly comes from myself and from other colleagues at the ECB. I don't think that this is an exhaustive, this list of research that I will present is exhaustive, but I think it's a nice way, brings to the narrative. And of course, I'm very happy if you have some other question to point you also to other important research in the field. Let me see. Okay. Also, what I will follow a bit this structure in my presentation because I think it helps to introduce some of the most important topic. First, I will talk a bit about how we got to the great financial crisis in 2008. Since a long time, but actually 12 years ago, basically, we had the biggest financial crisis of the last decades. And I will show you what can we say now about the role that possibly regulation and monetary policy have played somehow in bringing to some of the risk that eventually erupted during the great financial crisis. Of course, then I will say, okay, what have we learned from this and what were the reaction in terms of policies? Therefore, I will talk about the regulatory and supervisory changes implemented after the crisis and their implication. And I will talk towards the end of the talk about the interaction mainly with the concurrent monetary policy. So let me start with the first topic. What can we say about the role that regulation and monetary policy played in bringing to the great financial crisis? What have we learned in particular? In order to introduce this, I think it's important that we all have a sort of common understanding about why we regulate and what is regulation. So, as I said, regulation, there is regulation in several parts of the financial sector, but usually when we talk about regulation, we think about banks. And the rationale for regulating banks stems from the fact mainly that bank deposits are insured. And because there is this insurance of deposit, it is important that banks are supervised and monitor in their choice that they make in terms of risk taking. There is also the issue of maintaining a functioning system for payments and financial transactions. And banks, especially Europe, for example, are particularly important in that. So we cannot really have an economy that is functioning well if there is a functioning system for payments and financial transactions. I would say that more recently, especially, there's been a lot of interest towards non-banks intermediaries. I think in general, we know a bit less about the non-banking area. But of course, this is partly related to the fact that we have less data for some of these. and also a culture to look, I would say, a bit less to other non-bank intermediaries. There is also another important point that I would like to make about regulation, that regulation is supposed to serve two objectives, which are, of course, related, but they are not exactly the same thing. There is the idea that we want to have regulation and we want to be able to maybe prevent that there is a next financial crisis. But this is going to be very difficult because in general, the next financial crisis will never look like the previous one. But of course, there are ways to forecast the next crisis. But also, we would like to have regulation that is supporting the increase in the resilience of the system. And there has been, I think, a bit of a tension between these two objectives, and also like a movement towards talking more about resilience in the last few years. And actually, and this is one of, I mean, if we think about what's happening right now, resilience of the financial system is very important. If you think about the current crisis and the pandemic, I mean, of course, this is a shock that had, in principle, very little to do with the financial sector. But of course, it has hit the global economy so hard that obviously has an effect also on the financial sector, and will probably have a much larger effect on the years to come. And on the faces of this kind of shock, it is very, very important to have a resilient financial sector that can withstand this kind of shock. One point, of course, about regulation is how do we measure the effectiveness of regulation? How can we say if a regulation was effective, and how can we judge if there were side effects? Let me go back, as I was saying, let's start what happened before the great financial crisis. The guidelines for the regulation of the financial sector are set in general in Basel, at the Basel Committee. And the idea there is to sort of limit the scope for regulatory arbitrage across banks in the different global banks. So the idea is to have some common guidelines that they are taken by the different countries, and banks in the different countries basically have to abide to local legislation, of course. And in the EU, these Basel principles are enshrined in the so-called EU Directive. Before the great financial crisis, the important EU directive that was implemented was the so-called Basel II, that started to be implemented in 2005. What we see, I mean, going towards the crisis, we can see now that there was a general accumulation of imbalances. And when we talk about imbalances, usually we talk about credit. There are several papers right now that they show that one of the key feature for bringing it to a financial crisis is the accumulation of credit boom, big bubble, as you want to call it. And this is a bit what we have observed also before the great financial crisis. However, I mean, the important thing, if you want to prevent the crisis or want to generally make the system more resilient and not to achieve these very large imbalances, is to understand, okay, what are the factors behind this credit growth? And I will talk a bit about three factors in the case of the great financial crisis: regulation, monetary policy, and financial innovation. I should stop here. Do you have any questions?
So until now, there are no questions, Angela.
Thank you, Alex. Thanks. Okay. Here, maybe I will skip this slide and I will just go. Let's start talking about regulation. Here, I mean, this is a table that basically is part of a technical paper that was published in the spring. And then looks again at the relation between monetary policy and financial stability. And this is a table that looks at the developments in regulation in the EU before the great financial crisis. And I mean, I don't want you to basically focus on each specific issue, but what I would like you to see is that this arrow, this red arrow that mainly points to down, which basically implied that there was a general deregulating action going on before the great financial crisis. Here I will talk a bit about some work that was done by some of my colleagues, in particular Simone Manganelli and David Marques at the ECB. What they show is that certain bank characteristics in terms of asset and liability are consistently related to the increase in systemic risk. So what we show is that there was a general trend towards some sort of deregulation in the years before the great financial crisis. And this deregulation may have had something to do with the choices that banks have taken in terms of how to invest, I mean, in terms of their assets and of their liability and how to be funded. And indeed, in this paper, my colleagues find that these characteristics, the exposure to particular market, certain assets, in particular exposure to real estate, and also, I mean, how capitalized banks were, how were funded, for example, how short-term funding was used. These were all characteristics related to the fact that banks had eventually problem during the great financial crisis. Okay, sorry, I will stop here. Is there a question?
Yes, so there would be one question. And the question is, could you expand on the reason why there is a trade-off between the two objectives of regulation, so increasing resilience and forecasting the next crisis?
Because I think in general, there are the way I see it is the tension arises from the fact if we concentrate on forecasting the next crisis, basically we need to concentrate in finding the pockets in the financial sector where risk is increasing. And these pockets of the financial sector may not be always, it may not be possible to eventually decrease risk for also policy institutions. Simple example, banks and non-banks. So we know that risk is accumulating in some part of the non-banking sector, for example, at least for certain financial intermediaries, but it is difficult for policy institutions maybe to come up with policies that would actually address this kind of risk. On the other hand, I mean, for example, in Europe, banks are very important for the financial sector, and increasing resilience of the bank, for example, increasing capital requirement or other kind of requirement, is something that policy institutions, particularly supervisory institutions, can actually do. And the idea is that if we increase the resilience in some part of the financial sector, we do not necessarily avert the next crisis. I don't know, which we could have the next crisis in, I don't know, there could be a big crisis in the leveraged loan market, as an example. But the important thing is that this crisis will not spread through contagion through the rest of the financial sector, not necessarily. So we're going to have stress or maybe even crisis in some part of the financial sector, but this will not be distributed to the entire financial sector with very disruptive consequences. And I talk about tension because the two objectives are not overlapping, but they are also both important. So it's also important to try to understand where the risk is accumulating. And it's not enough to say, well, for example, as a supervisory authority, we only care about banks, and we don't care about what's going on in the rest of the financial sector.
There was also a second question, if you want to take it right now.
Yes.
So
Yes.
Angelo was asking. I'll just read it out, and Angelo, please jump in if I misunderstood you. He said, "Are there any conflicting forces? So is there evidence or ECB view about whether there are any conflicting forces between monetary policy and financial stability as an objective?"
That's the $1 million question. Can we discuss this at the end? I'm going to talk a bit about this at the end of the presentation.
Of course, I'll bring it up again at the end.
But this is a very important question. I will be happy to talk more about it also later. But I think it's better if we do it at the end. Thank you. So going back to what was the role of regulation before the great financial crisis, basically, I have some work that I've done with a co-author, which is Alessandro Scopelliti, in which we construct an index of regulatory effectiveness in exploiting the implementation of Basel II across EU countries. Now, without going into much detail, but the idea here is to exploit the fact that while there were common guidelines in the implementation of Basel II, there were national differences. And we exploit these national differences, and we construct two indicators. One, we call it regulatory flexibility, and the second one, supervisory discretion. And here, just for you to show, to say, we have here the index of country regulatory flexibility for all the countries for which we have data. And you can see that across the EU, I mean, in some countries, I mean, here we have that the higher value means that the country had a more flexible regulation. So you can see there was quite some variation across EU countries. And even more, there was quite some variation in terms of supervisory discretion across EU countries. And then with this index, what we do is we try to see if we can, there was a relationship between the probability for a bank to have asked for some kind of support during the financial crisis and the country in which these banks were located. And what we can see is that banks that were subject to less stringent prudential regulation before the crisis were more likely to require some form of public support during the crisis itself. We also have some suggesting evidence or regulatory spillover on liquidity buffers. And here, what I think this is an interesting result because it's also related to something that we saw more recently. Basel II was really about capital. The only requirements are related to capital requirement for the banks. But what we observe, and here, I mean, I don't want to go so much in detail into this plot, but here the idea is that even if the regulation was about capital, what we observe is that there was a relation between the regulatory flexibility index and the liquidity buffers during the years before the financial crisis. So the idea here is that in countries in which regulation was more flexible, and regulation again was about capital, but still in those countries, banks had generally less liquid assets than otherwise. So, I mean, this also is suggestive that there was indeed some relationship between capital and other part of the balance sheet, even if these were not introduced in the regulation as such. Of course, I mean, let's say, more important also, what we show also in this paper is that these liquid assets actually were mainly sovereign bonds. So in countries in which, in particular, supervisory discretion, for example, was very high, we found in general that in this country, banks tended to have more sovereign bond holdings. And I mean, this is suggestive of a different mechanism that could have brought to this. But the main thing is that we know that in 2011 and 2012, sovereign bond holdings of European banks were key in creating stress in the banking market because of the sovereign crisis. So there are limitations in this analysis, but I think this is very suggestive of how we can bring actually regulation with the risk accumulated in banks. Before I go to monetary policy, is there any other question?
So there was one question which says, which KPIs do you use to measure financial stability?
What is KPI?
Which indicators are you using in order to, I guess it's, Philip talks about key performance indicators, and I guess the question means how do you measure financial stability? Which variables?
Yeah, I mean, in general, financial stability, you can measure it in different ways, but it depends on, for example, you can measure it with some measure of systemic stress. I mean, this is there are several measures that you can also find, for example, in the financial stability report of all the central bank, you are going to find measure of systemic stress. And then it depends if you want an aggregate index of all the financial sector or an index that relate only to banks or some other intermediaries. But in general, I mean, these are index of some measure of stress. There is not one indicator, I mean, of financial stability. Here I just want to say also, we talk about the impact of regulation before the crisis. What about monetary policy? Here I have some work that I've done with my co-author, Luis Pedro, and what we look at is that in the euro area, before the great financial crisis, we can say that in some countries, maybe interest rates were lower than what would have been implied by some sort of optimal rule. Now, without going into much detail of this, but the idea here is that in some countries, because rates were relatively low, these very low rates have induced banks to be relatively relaxed in the way they gave out loans. So in some countries, banks gave loans in some countries, banks accumulated risk in their lending portfolio more than in other countries. And in particular, this happened in countries where interest rates were relatively low. So in order to show that, we use actually measure of lending, of credit lending from the bank lending survey of the Eurosystem, which is a very nice tool that is published every quarter in the website of the ECB. And I mean, you can see from this picture, I mean, what is this picture now without going so much in detail? But let's say that Taylor rule shocks are a sort of measures of how, relatively speaking, interest rates were low or high. So let's say that if interest rates are more or less where they should be, following a sort of optimal rule, you will find this dashed red line that should hover around zero. What we see, like after 2005, that is basically this dashed line started to be very much on the negative side. So meaning that, sorry, on the positive side, meaning that, I mean, there was a very big residual from this estimated rule, such that for some countries, rates were relatively low. And in these cases, what we found is that lending standards were particularly relaxed. And again, here the blue line and the yellow line, they are very, very close to zero, which means that in these countries, basically banks were not particularly restricting in giving out loans. And I mean, basically what this chart would like to show is that there is a relation also visually between these two things. Of course, in the paper, we do this in a more robust, we show this in a more robust way. We also show in other follow-up work that it's not only the level of the rates that is important, but also for how long rates are low. So this idea of the too low for too long that you might have heard sometime. And I mean, this work is actually consistent with works done also by other colleagues of mine. And here I also mentioned the work by Altunbas et al. And if I remember correctly, the speaker of tomorrow, Leonardo Gambacorta, is one of the authors of these studies, indeed. So I've talked about regulation, I've talked about monetary policy. The last thing I want to talk about is financial innovation. And here, I just want to show, I mean, this chart, what shows is basically securitization activity in Europe. So securitization activity in Europe was booming before the great financial crisis. And of course, this created, also facilitated for the banks, for example, to take out risk from their balance sheet in order not, for example, to be charged capital requirement for that. I mean, it's not, I'm being a bit loose here. This was not exactly the same in all countries, but this is pretty much the idea. Securitization allowed the bank to take out risk from their balance sheet. And so basically securitization made it easier for banks to take more risk. After the crisis, securitization basically evaporated pretty much in the euro area, and only more recently there have been a bit of pickup in the activities, probably also related to the fact that in the meantime, central banks have started also to buy securitized assets, which somehow revived a bit the market. I just want to say something now. What did we learn from all these things that I said? Now, there were many contributing factors favoring risk-taking in the financial sector before the crisis. What we can say about regulation is that I show you some suggestive evidence, but in general, what we can say is that regulation did not prevent risk accumulation, but in some instances, it seems that actually encouraged it. And the other thing that we learned from the experience of the crisis was also the emergence of a concept of systemic risk, which was, I mean, it was there also before the crisis, of course, but I think the crisis, in the crisis, it became obvious that looking at the stability of the single individual bank didn't really make a lot of sense if we're interested in, again, in the resilience of the financial sector. So I will stop here. Is there any question? And this would conclude basically the first part of my presentation.
So there are currently no questions. Thanks,
Alex. So, I mean, I did a bit of an overview of the impact of these different factors to the great financial crisis. Let's go on. What happened afterwards? Well, it happened that a lot of new regulations were implemented. There was a new regulatory framework that was implemented, Basel III, CRD4, that's what is related to the EU, of course. Generally higher capital requirements. There was a revision of the risk-weighted framework, new requirement. I will talk a bit more about this. There was also, very importantly, the implementation of the so-called macroprudential measure to address systemic risk. And there are macroprudential buffers, so very big banks that are considered systemic, they have additional capital requirement. There are countercyclical capital buffer, the so-called CCYBS, And this is also interesting because actually recently, because of the COVID-19 crisis, we have seen the first release of capital buffers, of these countercyclical capital buffers. So there was an accumulation very little of these capital buffers before the COVID-19 crisis, and when the crisis erupted, there was a release with the idea to support the banking system in this crisis. And then also other regulation. There was the centralization of supervision for large banks to the ECB in Europe, and also some other regulation pertaining to some other intermediaries, in particular EMIR for some derivatives market, and then Solvency II for the insurance corporation. Okay, what can we say about the effect of these policies? And here I go back to the bank lending survey, which, as I said, it's a very nice instrument that the ECB provides. And here, I mean, basically, they ask to the banks, okay, what was the effect of this tighter regulation? Well, pretty much all the banks say, well, because regulation are stricter, our lending conditions are tighter. And this is a general perception. I mean, there is always this idea that if you increase regulation, this is going to have a negative effect on credit provision. And this is the first point of this slide. And this is very important because also this feature is always incorporated also in the models evaluating the impact of these policies. All the models that we use, I mean, have such features in which we increase requirement, some sort of regulatory requirement, and this is going to have a negative effect on credit provision. The interesting thing is that when we look at the empirical evidence, especially in the last few years, for which we have a lot of data, this empirical evidence is not so crystal clear. Unfortunately, the main reason is that at the same time, there are a lot of other things going on. We have a very accommodative monetary policy stance and the use of, in particular, other the so-called unconventional monetary policy instrument. In particular, it's very interesting the role of capital. There is a lot of research going on this. I will be happy to point you to some of these. But for example, there's a very nice, just recently published paper by Hordash, Ularik, and Taylor, and they look at a very long history of data. And what they show is that bank capital doesn't seem to be very much related to preventing financial crisis. However, it is pretty much seen also if we look at very long history of data that when banks are well capitalized, then getting out of a crisis is actually quicker. And this goes back of what I was saying before, how important is resilient vis-a-vis of forecasting the next financial crisis. But in general, as I said, we have also some evidence that, if we increase capital requirement, this is going to have some sort of negative effect on banks' evaluation and on the provision of credit. Here I have some evidence from some work by my colleague Johannes Breckenfelder with Gert Beckert. And they use the inclusion of a bank in the OZ list. The OZ list is basically, again, another list of relatively large banks for which basically there is a bit of a higher systemic buffer that they have to fulfill. And indeed, what they show is that when a bank is put in the OZ list, and therefore it has to fulfill higher requirement, the valuation of these banks, both in terms of stocks and bonds, decline. There is also some additional work done by other colleagues at the European Central Bank that show that indeed the inclusion in the OZ list reduced credit supply to the non-financial sector on the side from this bank. The other thing is that in general, though, this kind of effect tend to be shorter, and this we can see it also in some models, and that I will talk about a bit more later on. Because in the medium term, of course, the impact of credit supply can be countervailed using some portfolio reallocation. I mean, because capital requirements tend to basically be related to some part of the portfolio of the banks, banks can reallocate their portfolio and try to lower again the requirements. So, I mean, these negative effects are typically much more short-term based. There is also here another important point. As I said, I mean, I listed a bit in that slide all the regulations that were implemented after the crisis. In general, there was an increase in regulation. There was also some regulation for the non-banking sector, but of course, banks are much more regulated. One issue that a lot of people are talking about, of course, is how much by regulating one part of the financial sector are creating the conditions such that the activities are just migrated outside the regulatory perimeter. And of course, it's a bit difficult to have evidence on this, or at least to establish causality on this. But of course, we have some evidence that is suggestive. In a theoretical framework, this is kind of obvious. We have models in which if we have some part of the financial sector that is regulated and some part that is less or not regulated, basically agents will optimally move some of the activities towards the non-regulated part. As I said, establish causality in an empirical setting is more difficult. But here I show, for example, for the US, this is I found a very nice chart from a paper by Amit Sero and his co-author that show that this is like basically the share in the US residential mortgage market that is taken by shadow banks. So in the US, mortgages are mainly given by non-banks. And this has been an obvious trend much more since more or less 2010, 2011, when certain regulatory changes have taken into effect. Now, in Europe, this is a bit less clear, I would say. But what can we say? We see also some important changes in Europe. And that's why now, I mean, also our group at the ECB, we're actually starting to analyze and trying to analyze much more the non-banking area. What we see is that financing via bonds is definitely on the rise. So on the left-hand side, you find basically the amount of corporate bonds relative to bank loans. So how much financing of the non-financial corporation in the euro area is done by banks and is done by corporate bonds. And you see that the amount of corporate bonds is much more on the rise since 2008. And on the right-hand side, what you see is the financial assets that are held by all the financial intermediaries, again in the euro area. So in the light blue is whatever is held by banks. And then you can see that pretty much assets held by banks in the euro area did not change much in the last few years. What has really changed? I mean, the increase in corporate bonds that were issued in the euro area have basically been absorbed by the non-banking sector. So the non-banking sector, which of course in this chart, I mean, everything has been aggregated in one sector, but we can say it's mainly funds for more short-term bonds, and for example, insurance corporation for the more longer-term bonds. This sector have absorbed all these additional assets that have been issued in order to fulfill the funding needs of the corporate sector in the euro area. So this is to say that also, again, in the euro area, there seemed to be a shift into this part of financing through outside of the banking sector, so outside the regulatory perimeter. Is there any question on this?
So there is no official question. I would maybe have one, Angela.
Yes.
Okay.
I was about to write in Alex, but I say maybe I should jump. Go ahead.
Okay, tell me.
Okay, so I go first, Angelo, or you?
You go.
Okay. Okay. So Angela, I was just wondering, can you maybe elaborate a bit on the reasons for why we see this development? So it looks a bit like we are moving more and more into a US-like system when it comes to financing, and so the role of banks, is it diminished by more and more corporates doing the financing for themselves instead of using banks?
Well, of course, there is not one reason, and as I said, this is something that we are planning now to study better in a more robust way in the short future, let's say. I think it's, as usual, a combination of factors. One is this, for example, the action of the central bank. Of course, this has contributed. In general, interest rates are very low. Therefore, this has made it very convenient to issue bonds for example, corporations that were already issuing bonds. And this is an interesting fact. What we observe, now, of course, what I show is very aggregate, but I know some other work that show where we can see that mainly it is true that the volume of bonds issued has increased, but actually the number of issuers has not really increased as much. So actually it's mainly corporations that were already issuing bonds, they're issuing much more. So this is a general thing related to the level of yields. Then the central banks are doing asset purchasing. They're also purchasing corporate bonds, which of course inflates the price and again, decrease the yields. But this implies that if bonds are eligible to be purchased by the central bank or to be used as collateral at the central bank, they carry a value such that it's very convenient to use these bonds. And then, of course, in general, of course, banks are very much, they are a bit more constrained in their capacity to issue loans. So this has also been instrumental in bringing corporations that can to issue more bonds, I would say. These are also like supply. There is also the demand side. Because of the very low interest rate, of course, all funds had a lot of money, much more money to invest. Also, the asset management industry in Europe has a lot of cash to be invested, and they are also demanding more like high-rated bonds, let's say. So,
thank you.
Yeah, from my side, I think many more people and policymakers believe that financial systemic risk increasingly come from entities that are not banks, right? If only because banks are being more regulated in the recent years, as you pointed out. I think that's a very good point. Now, what about the COVID crisis now? This morning with my students, we were discussing the difference, for instance, between the global financial crisis, the Lehman bust, and the ongoing crisis. And one difference is that, this is a very exogenous shock hitting first the economy and maybe then the financial system. On the contrary, the Lehman Brothers was a financial system crisis and then an economic crisis. Now, the question is the following. It's a tough question. So in the sense that you just can provide your spontaneous reaction and so on. What do you think, assuming that there's going to be a financial crisis, maybe do you think it's going to come more from non-banks rather than banks? Because they are actually doing this interesting regulatory arbitrage, if you want.
Okay, I don't know. What I can say is that it is true what you're saying. There is a general perception, which I personally, I'm not sure I completely subscribe, that risks are much more accumulated in the non-banking area. So there is this perception that right now, banking sector is safe. What I would say is that to me, this probably sounds okay on the short, medium term, but I don't think this is going to be true on the long term. And I think there is also like a general perception also among policymakers about this. So what I think is that the non-banks, we have seen a lot of stress in the market in March, as soon as we have the crisis, especially coming from non-banks, because there was a lot of redemption in the funding sector, for example. And of course, there was some sort of fire sale. They started to, certain markets were really under stress, the commercial paper market and so on. So to me, this is really a financial stability issue. And in this sense, the central bank intervened. Now we can talk about if the Fed has done some things, the ECB has done certain things, it was enough, they could have done less, more. But in any case, they intervened. And I think in general, the stress was put under control. So this is really financial stability. For the banks, to me, the problem is going to be in some time, already we see some sign of this, we're going to see an increase in NPL for sure. I mean, there is going to be corporations that will not be able to repay the loans that they have taken. And then we will have to see, I mean, this risk will go back to the sovereign because, for example, in Italy, a lot of the recent loans have been guaranteed by the government. So it will go to the sovereign in different degrees in different countries. And in any case, it will stay with the bank up to a certain point. And then I think the risk will materialize. And there we'll see in which country the banking sector will be able to withstand this kind of risk. So that's what I would say.
So, Angela, there was one other related question. And by the way, you can go a bit longer than 4 p.m. then, since we are already taking questions now.
Yeah, sure.
The question goes as follows. Do these dynamics increase systemic risk because they move risk to a less regulated sector, or decrease risk because they reduce the concentration of risk in just one sector?
You mean what?
So.
Okay, no, that's a very, very good question. I think in general, we don't like concentration of risk. So I would say as someone who has this kind of mind frame, I think in general, having risk that is more dispersed in different parts of the financial sector sounds good to me. It is true, though, that because we do not have a very good grasp of certain part of the financial sector, it's also very difficult to assess the risk that is actually accumulated in this part. I mean, because we monitor very strictly the banking sector, of course, the banking sector is very complex. I mean, some banks are very big and so on. So it may be very difficult to assess the true risk, but we have, in theory, the means to do that. On the other hand, we know much less about other parts of the financial sector, so I think the assessment of this risk may be more difficult. There is also the issue, which is less financial stability, but also important, this concept of the spare tire that you might have heard sometime. This idea that if we have a diversified financial sector, a bit like US style, in a crisis, there would be a spare tire. I mean, if you have a crisis in the banking sector, the markets, the corporate bond market would provide a spare tire such that corporation can still fund through the market. This is a very interesting concept. In reality, what we see is that when there is a lot of stress in the markets, then spare tire do not really work so much. So this is also an important aspect. So diversity is definitely good. In normal time, in crisis time, it's debatable. I mean, it's not really clear that one system is definitely better.
Okay, and maybe one last question, which should be quick to answer. Yeah. What about non-performing loans in non-bank financial institutions? Do these institutions also perform stress tests on their own? And are the indicators they are using similar to stress tests performed by the banking sector?
To be honest, I mean, I don't know. I don't think they are performing stress tests at the level that we are doing for the banks. I think there is some stress test exercise being done in other non-banks, but I don't think it is anything similar to what is done by the banking sector. So I would say that is similar. Yeah.
And I mean, when we talk about non-performing loans, it's usually loans given out by banks, right? So non-banks.
Yeah, usually it's non-performing loans by banks, but of course, I mean, there are some. I mean, in some euro area countries, there are loans that are given also by non-banks. Mm-hmm. But I would say, of course, by and large, the majority of loans in the euro area are given by banks.
Okay, thanks.
So very quickly, one aspect I talk about regulation, or one important aspect also that we're seeing changing during the last few years has been the fact that the ECB, for example, in the euro area, took supervision of the most significant banks. So the ECB now directly supervises 116 significant banks of the participating country. Of course, these are the biggest banks, and they are the most important one. This is an important aspect because this has increased what's called the burden of supervision. I mean, these banks, it is perceived that these banks now are supervised in a stricter way compared to what was done before. And here I have a couple of pieces of evidence. This is a paper by Franco Fiordelisi and his co-author that shows that basically, in a very, very striking way, banks that were included in the SSM list, they decrease their asset side. So they decrease aggregate lending even in anticipation of being supervised by the SSM. And similarly, we have that between 2012 and 2013, banks tried not to be included in the list of banks to be supervised by the SSM. Now, basically, if you see this picture, we have on the x-axis the asset of a bank in 2012, and in the vertical axis, the axis of the banks in 2013, and all these dots are banks. So basically, these are all the banks that were in the area. I mean, of course, if they are on the 45-degree line, they would be basically around the threshold of 30 billion of assets. That is the threshold such that a bank is supervised by the SSM and by the ECB. So all these banks were around this area. And what is shown, and here, I mean, there is some work by some of my colleagues as well, is that between 2012 and 2013, there was a group of banks that actually strategically reduced their assets, they shrank their assets in order not to be supervised by the ECB. And this is very interesting because it shows really like this perception that, okay, centralization of supervision was seen again as something making not only regulation tighter, but also supervision tighter. I think I will skip these two slides that are related to the impact of leverage ratio requirement on the money markets. And this is because I would like to talk about the last part of the talk, which is the interaction with monetary policy. So I talk about regulation. I talk about the effect of some of this regulation. Let me talk now a bit about with the interaction with monetary policy. Here I will talk about two things, negative rates and asset purchases. There are a lot of other aspects that are important, and I'll be happy also to answer questions about this. So what's special about negative rates? Why are they special? Well, in theory, they're not so special. A rate, it's just nominal rate that go below zero, right? I mean, you have a rate at a certain point become negative. However, what we have learned is that banks are reluctant to set negative rates on deposits. And in particular, they are reluctant to set negative rates on deposit to retail depositor, in particular households. So here I list some work that is done by some of my colleagues at the ECB. They look at the at the impact of negative rates. As I said, negative rates are special because banks do not charge negative rates on household retail deposits. And in general, these hurts. So negative rates tend to hurt more the profitability of banks that have a lot of deposits. And we have some evidence on this. Here I show you like a chart that shows basically, if you see, this is the volume interest rate on overnight deposits held by households in the euro area. So the blue is like, okay, the volume of non-negative deposit rate. And the red, which of course you can see very bad because it's very, very little, is deposits that are actually charging negative rates. For corporation, this is a bit different. And you see that actually, indeed, banks do charge negative rates for depositors that are corporation. So there is some transmission of negative rates, but the important thing is that this transmission is not the same. So this policy obviously has a differential impact for banks that are much more dependent on deposit compared to banks that are less dependent on deposit. And here I take from the work of my colleague Florian Heider and Glenn Sheppen. They show that basically banks with a lot of depositors are indeed valued less. And they also show that indeed these banks with a larger deposit base tend to lend to riskier firms. I mean, now this picture shows basically that riskier firms here in this analysis are proxied by firms that have higher volatility of return on asset. And they show that indeed banks that are more dependent on deposit tend to lend relatively more to this kind of firms. So some sort of idea that banks have to make up for being negatively affected by negative rates by increasing the risk on their lending portfolio. It's also interesting that we found consistent evidence when we look at fixed rate mortgages, and here is a paper based on Italian banks, and also banks that are more dependent on bank deposit. They also invest in riskier security, and that's a paper that I have with my co-author Johannes Pubeck and José Luis Pedro. So overall, negative rates seem to imply some sort of risk-taking. A bit problematic maybe that this risk-taking is not is heterogeneous across different banks. And this I will go on. Let me say a couple of words now about asset purchases. We know that the announcement of asset purchases program have reduced sovereign yields on long-term bonds and raised the share price of banks that held more sovereign bonds in their portfolio. So there was some general valuation effect coming from asset purchases through the banks. At the same time, there is an impact on market functioning. Asset purchases increase the scarcity of assets. I have some work that I've done with my colleague Stefano Corradin, in particular on the repo market, but there is also some other evidence in other markets. I mean, scarcity of certain assets, when there are heavy purchases of the central bank, tend to increase. There is also an issue that is, for example, related more to the current situation, that asset purchases seem to be related to an increase in market segmentation in the bond market and possible some cliff effects due to rating downgrades. Let me just elaborate a bit on these two aspects. First of all, the scarcity, and here I refer to my work that I mentioned before. Specialness, as measured by in the repo market, is a measure of the scarcity premium in this market. And what we see that specialness increased very much during the period in 2011, when there were very, very high purchases of the ECB in the Italian bond market. I mean, this paper is using data on the Italian bond market. So scarcity increased a lot in certain markets when asset purchases are going on. And here, basically, again, we show that if we did not have asset purchases, specialness of certain assets would be much lower. The other point I wanted to make is that in the euro area, corporate bonds that are issued by euro area corporations tend to be rated close to the threshold for the investment category. Here you see, I mean, basically the outstanding euro area corporate bonds per rating category, and you see where the frequency is higher. This poses a problem because, of course, as long as corporate bonds are included in the investment grade category, they are eligible to be purchased by the central bank. As soon as they go down in the rating category, they would not be more eligible. This most likely could create important cliff effects in the market with possible very disruptive consequences. So really market consequences deriving simply by the asset purchase policy of the central bank. So any question here?
So there are a couple of questions. We have about 8 minutes left. So I would suggest maybe you conclude, and then we have Angelo questions and 3 outstanding questions that we can then take.
Okay, so I will just conclude with the last thing I want to say. And this goes back to the question that Angelo had about the interaction between macroprudential and monetary policy. Actually, we have a lot of work that we are doing into this area. This is, of course, not an easy area. So we have done some work, and here I refer to a published paper that you can find on the ECB website, in which we analyze the short and long-term impact from higher capital requirement. And I mean, what is evident already from some model simulation that you can see in that paper is that the long-term impact depends on the risk in the banking system. So, I mean, if we have capital requirements that are increased, but they make the system more resilient, actually these on the long term will have a beneficial effect. On the short term, there is generally a negative effect, as I said before. I mean, if we increase capital requirement of any other regulation, we are going to have a negative effect also on the credit given to the economy and on the economic growth in general. However, this effect depends strongly on how much monetary policy adjusts. So there seems to be space for a coordination between these two policies. If we have a very accommodative monetary policy, probably we need to have macroprudential policies that try to tame the risk that are accumulated in some part of the financial sector. If we have very relaxed macroprudential policy, because, for example, we are in a crisis or so on, then also, if we increase macroprudential policy, on the other hand, we need to have accommodative monetary policy that try not to counteract what macroprudential policy is doing. And this is basically, I mean, some first idea about how the two policies can interact. So going back to the question of Angelo, is there a space between coordination of the two policies? I mean, of course, this is the subject of very much of a large debate also inside among policymakers. So we know that there are important interactions between the two policies. And we know that in theory, we don't want to end up in places in which the two policies are actually doing they are acting into different directions. This is a bit what we observe probably in the first part of the great financial crisis, in which regulation was generally increased in the euro area, and at the same time, monetary policy was very accommodative. So we would like to avoid this kind of situation. So what happened now with the COVID-19 crisis? There was some sort of coordination between these two policies. Maybe it was, I don't know how much explicit was that, but I think in the case of the euro area it was pretty much explicit. The ECB, the central bank, started as the purchases and other action in order to help and to provide liquidity to the system and to the economy. And at the same time, there was a relaxation of requirement in the supervisory area, in the prudential area. Active coordination of these two policies is difficult because, of course, people in charge are different. There are limitations in how much policies can be coordinated. And this also in the euro area has to do a lot with the current setup. Macroprudential policy, a lot of time is set up at the national level. So the ECB does not really have a macroprudential instrument that can be used, except increasing capital requirement, which probably would not do. And on the other hand, of course, we do not have macroprudential policy that is entering into some part of the financial sector. So I don't know if this sort of answer the question of Angelo.
Yes,
Okay.
thank you.
So Angela, we have 5 questions from the audience.
Okay.
And about 3 minutes
Yeah,
left.
pretty much I finished. I mean, it's like this is finished. So let's have the question. Let's try to
Okay,
wrap it
great.
up. Yeah.
Yeah, great. So so about 5 questions. Maybe you can keep the answers roughly below 1 minute. That would be great. First one is since the shadow banking sector was one of the main reasons for the financial crisis, how come the sector was not regulated as tightly as banks?
I would not agree with the fact that the shadow banking sector was the main reason of the crisis. I think this is, I mean, the idea is that there was a lot of problems arising from ABS, the ABS market, that's for sure. But at the end, I mean, the problems came on the banking side. So where banks and other intermediaries that were holding this kind of instruments. So at the end, it's, I mean, I don't think that the problem were arising from the shadow banking. Another way to answer this question is that, of course, it's easier to regulate entities. It's not easy to regulate instruments. Mm-hmm.
So the next question, I'm not sure how to what extent you are into blockchain and cryptocurrencies, but the next question goes as follows. Could a decentralized financial system, so one built on cryptocurrencies, token economics, smart contracts, and so on, could such a system benefit from financial crisis in terms of higher adoption? So more specific, do people move from the traditional financial system to a decentralized financial system in search for liquidity in times of crisis?
So it's like, I mean, first of all, I'm really not an expert in this area, but if I understand correctly, the idea is that this kind of instrument would provide some sort of parallel way of getting liquidity. I mean, this is definitely a possibility. My understanding, and again, it's very limited, my understanding in this area, is that sooner or later, liquidity, I mean, the search for liquidity will go back to the main provider of liquidity, which are the central bank. So I don't know if it is possible really to construct a system that is completely outside of the central banking and the supply of liquidity, like formal supply of liquidity. Mm-hmm.
Have negative interest rates negatively impacted the profitability of banks in the Eurozone?
There is a lot of debate about this. And there are also different views, I can tell you, in the ECB about this. I think for sure they have affected differently different banks. So depending on the business model of the banks, some banks are more affected than others. There is also a short-term versus long-term issue. On the short term, I would say that probably banks are very much, can absorb even small negative effects from negative rates. On the long term, it's likely that we're going to see more negative effects.
Mm-hmm. And the last two questions are both related to monetary policy and systemic risk or financial stability. The first one is, we recently discussed the overall scarcity of safe assets, that this is also a contributing factor to negative interest rates. At the same time, banks are lending to riskier firms. And the question is this sustainable? And maybe let me give you the second question as well, because it's very similar or related. Is the fact that banks with more deposits counterbalance their reduced profitability by lending to riskier firms an unexpected or unintended consequence of monetary policy, or was it accounted for ex ante?
Well, these things of accounted for ex ante is difficult. Maybe we had some ideas, but I think it's, it's always difficult to really account for all these side effects ex ante. Let me say something about this. Of course, what I show is it has to do a lot with the heterogeneous impact. So we know that a negative rates in this domain, I show you that banks that are more affected, that have more deposit base, they increase their lending to riskier firms. So for sure, there is a difference across banks. Does this is a negative impact overall? This is much more difficult to assess. We think that the negative rates policy has had overall a beneficial impact to economic growth, at least until now. That if we had not done this, probably we would have had more negative consequences for the economy in general. I personally have some doubt that on the long term, we're going to see much more beneficial effect. So the issue for me is really short-term, long-term. The fact that monetary policy is accommodative and banks are taking more risk is not necessarily a negative thing. In the end, the reason why monetary policy is accommodative is because we want some actors, some agents in the economy to take more risk, because that's what is needed. The problem is to account for that risk in the correct way.
Okay, great. So then let me already thank you from my side for the presentation and for answering all the questions. And then I would hand over to Angelo for some concluding remarks.
I think it was a very...
Thank you very much.
Yes, Angela, great job. Very stimulating presentation. And thank you very much. So I'm sure I will look carefully all the slides and maybe also your answer to our question. Thank you very much. So we will see you for the next webinars if you are interested.
Thank you.
Yes, thank you. Tomorrow. Bye-bye then.
Thank you. Bye-bye.